As always, I'm going to read my disclaimer first, and then we'll get started on our second session of Scalping University. Please note the following video is for educational purposes only. No claim is made as to the accuracy or efficacy of any trading strategies contained in this video. As always, use your own discretion, and as always, use your own ideas in anything that I show you here. Now, I want to welcome you back, actually, to our second week of Summer Scalping University. This week's lesson is called Trading Session Breakouts, and it is really surrounds itself around the breakout from the Asia session into the highest liquidity times of the day, which is London and New York. So the basic setup assumptions are the following. 80% of the time, the Asian session trade simply consolidates. There are occasions when you have monster moves during Asian session, at which times this setup no longer applies. But generally, when the Asian session just doesn't have much of a range, a 30, 40-point range, then clearly it's a time of consolidation. And basically, London and New York provides the true liquidity and the directionality in FX. Now, this happens for a whole bunch of reasons. Primarily, obviously, most of the traders in the world trade through London and New York. That's when all the market participants come together. But it's also when all of the news that's really important that affects the FX market hits the tape. And it's that news that tends to create the volume and the liquidity provided by New York and London that tends to drive price and directionality in one way or the other. So, given that assumption, then a break of the 00 level in the London-New York session generally suggests continuity, at least some continuity in that direction, because you're taking out the new penny level in the key major currency during the time of most intense scrutiny. So here's an example of a classic sort of a euro-dollar. You can see that this is the Asian session. Now, the way I define Asian session, by the way, is around 6 p.m. to 2 p.m. New York time, which is 18 plus 4 is 22 to 6 a.m. GMT. But really, in my opinion, the London to New York session doesn't really start to get going until about 3 a.m. my time, which is about 7 a.m. GMT. And it's really only the breaks through those particular times that catch my eye. This is an example of the euro-dollar getting taken out at the 32 handle on the publication of this UK Telegraph story that the Fed is going to increase its quantitative easing. This was the beginning of the week. This is a major story because it created this whole new paradigm of anti-dollar sentiment, because the suggestion here is that everybody else is tightening, but the Fed is in such desperate shape as far as the economy goes. They're actually considering a second round of QE, which is highly dilutive to the currency, and this turns the whole currency market around. So you can see they take out the 32, and of course you definitely see some continuity there. So the bottom line is the way I sort of use the rules for the setup is we trade only between 2 a.m. and 3 p.m. Eastern Time, which is 6 to 21 GMT. The price crosses the 00 line to the upside. Then we enter limit at 00. We place the stop at 30 back. So the stop would be actually at 70 on the downside. And we exit at 15. And on the short side, it's the exact same thing. We're sort of coming in between 2 a.m. 3 p.m. Eastern Time. The price crosses to the 00 to the downside. We enter limit at 0. We should place the stop. This is the wrong. We place the stop at 30. Ha. Look at this. I'm correcting my PowerPoint as we speak. Because obviously I'm giving myself 30 points of stops. And I'm giving myself only about 15 points of entry. There we go. You see, you have to be flexible even when you're making PowerPoint presentations. Anyways, the point being is a lot of people will ask, why is there a 1 to 2 risk-reward ratio in this strategy? I mean, it seems very unfavorable. And in many ways it is, which is why I'm going to bring up the last point of this thing, which is crucial to, I think, its success. But the reason generally why there's a 1 to 2 risk-reward is because the retrace risk is often very heavy. Once you penetrate the 00 and you break the key level, the initial reaction usually is always to take profits and to set back before the original trend sets in. So one of the things that I'm trying to avoid by giving myself a little more room as far as the stop goes is to give myself that room of the retrace risk. You'll take the 00, it'll come back to 80 stop you out and then resume its risk. And I really don't want to see that happening a lot, because that's actually a lot more inefficient than having a wider stop and a tighter target than having a tighter stop, because you can have 2 or 3 attempts and you'd be taken out 2 or 3 times on a -20, which is much more painful and actually much more costly than just one time on a -30. Generally, obviously, of course, if you're maintaining a 70% win-loss ratio, the setup is net profitable. But here, and this is the big kicker, the kicker for this setup is that you really want to have the fund to flow, because that's really what makes the difference between winning and losing. In other words, a random breakout above the 00 level will sometimes work, will sometimes not work. But if you have a break of the 00 level that is preceded by some sort of positive news in that direction, then your probability of continuation is much higher. So even though it may seem sort of extended, it may seem that the price has already run to the 00 level, if you have fundamentals on your side, it's actually a reasonably good time to enter, because you will get extension. You will get the move in the currency pair. So just a couple of examples for us to take a look at. Here's the euro dollar that we talked about. This is the trade that I showed you earlier. This is the breakout off of the UK Telegraph story in the euro dollar. Another good example that I kind of want to show you here. Euro dollar generally has been just sort of range bound between 32 and 31 most of this week, but it's really a good example today. Today was a prime example of when you want to use fundamental flow, not just pure price action. Because you can take a look here, and what's going on here? We have Asia session, consolidation. We have a few very anemic breakouts to the 32 level at 3 o'clock in the morning. Well, is that really a meaningful breakout? I mean, that's a breakout not supported by any fundamental data around there. And as a matter of fact, you know that NFPs are around, so it's very unlikely that you're going to have massive movement in that direction. So taking this particular trade without any kind of fundamental flow is really without merit. On the other hand, you have the exact same dynamic into the NFPs. Once the NFPs print, we start to race. And we actually, and trust me, because I was in the midst of all of this, you had plenty of time to get into the trade, because the trade went through 32, came back and retraced, and then gave you a chance to come back into the 32 handle, because the market was sort of pausing, trying to figure out whether it was really pro-euro on this particular trade. Well, clearly, negative NFP print, if you did your analysis beforehand, the anti-dollar flow, the anti-dollar sentiment likely was going to overwhelm any kind of risk aversion situation that was going on there, and that likely gave you a reasonable opportunity to get long at the 32, and of course, you took out the 32. And then, more importantly, this is a really, really interesting idea. Once the momentum got going and they took out the 33, you had the extension to the 33 as well, because at this point, you clearly had the momentum on your side, and you were trading with the flow. Both of these examples, you could have taken the 00 handle and done quite well. Myself, I really didn't trade this setup much this week, because it is my lesson number 2, not my lesson number 1. I showed you my best setup last week, and that's the one I primarily trade. But the one clear example that I did trade this week that really worked very well was Wednesday afternoon. This is all, of course, pre-NFPs, when we have the good positive ISM number come out. The ISM number comes out, and it completely sort of reverses the psychology of the market, in a sense that it makes the market think that, yes, NFPs are going to be strong, the whole QE concerns are going to go off the table, and dollar-yen rallies. Now, I take the 86 in the dollar-yen, because that's, again, a 0-0 level, clearly important. And the dollar-yen actually rallied for a serious amount of time, all the way up to 40. I, of course, took my profits at around 15, as per my setup. But this was a good example of using levels, using fundamentals, and of course, if you can go back, this is a breakout of the Asia session, and that was very, very important to take out. So that is the session-based breakout, lesson number 2 of the Scalping University series. I'll see you guys next week with more lessons and more ideas. Wishing you the best of luck and the best of trading. This is Boris Schlossberg for BK Forex Advisors. Over and out.